Everyone, welcome to the Sunday Weekly Show. And I think we have, who's that? Julian. Hi, Julian.
Hello, Lloyd. Hey, guys. How are you? And hello, everybody, wherever you are in the world. Welcome to Sunday afternoon, Sunday evening, or wherever it may happen to be, Sunday morning if you're based in Europe. Welcome. So I think with Paul being AWOL in Sydney and my bad hairdo, what we're going to try and do is get through the next 10 minutes where we're talking about the macro market environment and maybe what we're going to have for the week ahead. So look, just a quick recap of where we are. I think I would classify last week as about as boring as it gets until Friday. And Friday was a pretty key and significant market day. The price action, as I'm sure most of you know, was pretty awful and very US dollar related. So very anti-trend. The current feeling for the last few weeks has been that the dollar is going to go down and the US dollar is going to go down and the other currencies are going to do better. Maybe with the small exception of the Canadian dollar, that was pretty much reversed on Friday, and we saw a significant amount of selling across a major number of asset classes, not just in the currencies, but also in other commodities as well too. So gold had a bit of a bad day on Thursday and didn't really follow through on Friday, but sort of sat on the bottom of the price action from Thursday. And the stock market in the US, I believe, opened a little higher on Thursday, sold off significantly, and then Friday followed through with that price action to close pretty near the lows of the week and also near the lows of the trading range. This is really important for me. So for a number of weeks, I've been saying that there will be a point in time that the US asset market, US stock market especially, is going to look at maybe a realization that there's a huge amount of supply around in the stock market right now, and the demand maybe is starting to dry up. And I think possibly that we're starting to see that really come through in the price action. It's been happening in various sectors. But it hasn't been happening in the overall market. Sometimes you get these sector rotations, which are quite common around a market top, where one sector deteriorates, where another sector comes back, and you start to see sort of volatile price action. But the overall index remains relatively benign and often, in fact, climbs to a new positive level. Well, the last few days, what we've seen, in fact, is that if you like, that distribution, that consolidation in the market, really start to struggle a little bit, and I think start to get to the point where the market's feeling a little bit heavy. And I think that's how I'd probably describe it, as being heavy. Is it a bear market today? No, of course not. Right? We've had one bad day. We need to give the market a little bit more time. But what this means, and the reason why I'm focusing on this today, as well as possibly a rise in bond yields over the course of the last few days as well too, is really we need to be conscious that a rally in the US dollar, a fall off in some of the fairly amazing multiples that we're seeing in the US stock market by the prices coming back a little bit, to some extent is a sort of a natural corrective element. The market maybe should try and go sideways for a little bit, if not a little bit down, to give people an opportunity to rebalance and think about whether they want to try and push ahead again. So at the end of the day, really what I always try and focus on when I look at these things is demand and supply. And there's been a huge amount of supply come to market. And yeah, there's been a significant amount of demand. If you look at the last 6 months, I believe the amount of inflows into stocks has been greater than it has been in the last 12 years combined. But that's yesterday's story, right? Tomorrow's story is there's still supply coming to the stocks. And if the demand doesn't keep up at the levels that we've seen over the last few months, then the inevitable is going to happen, right? Supply will win out, and prices will start to fall away a little bit as we try and get to a more reasonable valuation by historical standards. So, blowout week for earnings. We've got a stimulus package that was unbelievable. There's an infrastructure bill that's coming through, which is significant. The Treasury is trying to spend cash like absolute crazy. Some of the stuff left over from the Trump era. All of that has taken place in the last 6 weeks. And we're not seeing the market really trade that well now. So I'm cautious. I think there's going to be be a very interesting week going forward. I often say this, actually, it's going to be an interesting week going forward, but I think this time it probably is really going to be interesting. If we see follow through in those stock markets, what is going to happen to that US dollar? Is it going to continue to rise? There's a lot of people who are long of non-US dollar currencies at the moment. There's a lot of positions invested in the US dollar continuing to go down. If that is reversed for whatever reason, and sometimes it's just that demand and supply, buyers and sellers argument. If that is reversed, then we're going to see some more substantial corrections. So my call is Friday will be interesting. Monday is going to be far more important. So if we see follow through, and this is my big theme of next week, what is the follow through going to be? If we see follow through to the downside in the stocks and follow through to the downside in the US dollar against some of these currencies, then I think we're going to see some significant price action and volatility will pick up and will not recede, as you'd normally seen in the past with these things. Sometimes you get these big one-day corrections or two-day corrections happening. The market settles down and goes boring while it claws its way back. This is why follow-through is so important. So Monday, Tuesday, vital days to me to see what happens in the markets. From a fundamental perspective, my sense is we're still living the dream of earnings announcements in the States. Some of them have been incredible. You've seen the blowout earnings from a number of the big tech companies and what that's done for the market. In my mind, they've been amazing, literally amazing earnings for that first quarter. But the follow through has been pretty rough. So that suggests to me that most people already own those stocks in the first place. And who's going to be the new buyer coming in to push it to new valuations? And I think that's the critical thing, right? So a lot of people are very positive on stocks, which means they probably own them already. Less so in the bond market. I suspect they're probably short there. And so we're going to see some very interesting price action, I think, occurring in both those bond and stock markets for the next 2 or 3 weeks. That's really pretty much it for me. I think, cycle-wise, we're at a point whereby, if you go look at some medium-term cycles, I did that, showed you, you guys that work about 3 weeks ago. We're at an inflection point right here, right now, going back some time. So again, is this all normal that we're going to see a correction? Well, yes, it is. And what does that really mean? Let's get a bit of perspective here. We lose 10% in the S&P. What does it mean? Well, actually, it doesn't really mean an awful lot. So it doesn't mean an awful lot for the economy. People are pricing in a recovery that's already priced into the market. What will derail that recovery and derail the market from here on in would be a resurgence of COVID, which quite frankly seems unlikely in the US. They seem to be getting on top of it. That's not the case in India, and I feel for everybody there. It's a truly horrible situation and terrible underreporting, I suspect, for the actual numbers. Everybody I read and speak to out there seems to think that there's a real crisis going on. So, we obviously wish our Indian friends and also some of the surrounding countries well in their journey and their battle through all of this. But the reality is, are they going to hold up the world economy because of it? My suspicion is probably not. The recovery is pretty much well entrenched, and we need to give this a bit of time. But any hiccup there will probably add fuel to the fire if a stock market correction was to occur. So that's my theme for the week, follow through, and we're going to see what that looks like in the price action. This is one of those occasions when probably you break the low of Friday, it's actually more significant than you think. It wouldn't necessarily be a buying opportunity this time around. And that's pretty much it for me, Lloyd. Thank you.
Thank you, Julian. Yeah, actually, recent weeks, or I would say recent months, I've also been playing observation during the Monday Open to see what the market's going to go. I think that served me pretty well up to now. Yeah. And given to what you just said, actually recently I acquired a new bond. I think it was Rakuten. That was pretty good. And I'm still unsure of the stock market. I'm still kind of bullish about it, but not entirely sure. So I just switched my portfolio to more of a dollar cost averaging mode. Yeah, I don't really want to go lump sum in that particular stock or that stock. Right? To me, the fundamentals have yet to catch up to the pricing at the moment. So I'm kind of a bit iffy about that. So might as well just dollar cost average and don't want to worry about it. At least that's my approach to the market.
Yeah, and look, I think you've actually raised a really important point there, to be honest with you, Lloyd. So one of the things is the market is quite bright, and guys, folks out there, if you're listening to this and you're thinking, well, hang on a second, all these blowout earnings and yet the market doesn't go up. Well, don't forget the market discounts a lot of that. So for some period of time, it's been thinking about these blowout earnings. It's been expecting these blowout earnings. The economy is recovering. It's been expecting that. So the market has discounted a lot of these great results and the economy recovering a number of months ago. And it's pushed onto valuations that are stretching even that thesis, right? And there's the thing, right? So anything that goes slightly wrong here would add fuel to a fire of oversupply. So there's two things at play, right? There's the fundamentals and there's also the demand supply balance. Right now, there's a lot of paper in the street and there aren't as many people as you think to absorb that paper simply because they've already got invested. So We'll see what happens. I suspect the demand supply imbalance and a catalyst will lead us to maybe a bit deeper than a 4 or 5% correction, but who knows? We'll see. Nobody knows what the future is going to hold, but I'm just really cautious from here on in. I have been for about 4 or 5 weeks now. This is probably the time when I think if you're looking at a decision point and an inflection point, we're pretty much here.
Okay, thank you, Julian. And